But Art Laffer, the former Reagan economic Svengali, has advised both Democratic and Republican presidents over the years, says there's really no way you can put lipstick on this high-priced pig here. Art, you know, it is what it is, right? I mean, you can look at a monthly gain of 0.1% and ignore the 0.6% core monthly gain. You cannot focus on the year-over-year 8+% run-up in prices that is right now unabated. But it is what it is.
It is. And, you know, we had a very sharp rise in spot commodity prices in the beginning, which gave us year-over-year inflation much higher than it should be. The core was much lower. And now it's reversed itself. So you've got the core still going up, but you've got the spot commodity prices bringing it down to about flat per month. OK, I think the president was correct on those numbers. But that's not the real thing. The core is there. And over the next year, I don't see anything that would tell me that inflation will be coming down in the sense of the core or the basic rate of inflation. And your earlier comments, by the way, on the stock market, you also, when you're looking at peaks to peaks and last troughs, remember you've got the real stock market. If you deflated that S&P 500 number by the 10% or 8% inflation, it would be much lower today than it was back then. So, you know, we want to look at everything in an inflation-adjusted world.
Yeah, that's a good point. I mean, in real terms, you've lost another, 8 to 9 to 10% on top of those year-to-date numbers, which are dismal enough as they are. This is the week the Federal Reserve meets again. Expectations are for another 3/4 point hike. How do you think these hikes are working on this?
Well, they aren't working on this very well because, frankly, the way they set the interest rates, Neil, it's a price control mechanism. What really needs to be done is market rates have to get up. The controlled rates have to get up to the market rates before they'll start having the real effect on this, just the way Volcker did it. He allowed rates to seek their own level, and that's why we got rid of inflation so quickly. These people are not doing that. They're trying to control the rise in rates, and they're going to have to keep raising those rates until they get in the market area, and that's a long way off. With inflation running 6, 7, 8%, the spot, the 30-day T-bill yield should be much higher than it is at 4%. It should be maybe 6 or 7%. And that would be if the real yield were 0, which you can't have a real yield of 0 and not have a recession, downturn, or bad, because the real yield is the expected real return on a unit of capital over the coming period, a year or 2 years or 10 years. And so it's really a very tough situation they're in, but I think they need to raise those rates up to market rates as fast as they can.
In the meantime, we do know the effect of these higher rates. Obviously, it's obvious hitting the real return you're getting in the stock market, but it's also competition for stocks in general. If you get a 10-year note now north of, 3.5%, you got a 2-year note not that far from 3.9%. You have competition, and safe competition at that. If your goal is just to protect what you got, because a lot of people have lost a lot in the stock market, that could be a sort of a double whammy, right?
Yeah, well, the 10-year one is a real dangerous asset to buy to equilibrate with stock market. You're looking at a 10-year period, Neil, with a 3.48 or whatever the number is this second. But that's not a good yield in an inflation environment the way we have right now. I don't think that's in competition. If the 10-year bond yield were in competition with stocks or with the market or with the U.S. or world economy, I think the 10-year bond yield should be in the 7, 8, 9, 10% range right now.
But we do know it's higher. We do know it's higher than a lot of stocks' dividend yields. So I guess what I'm asking here is it another reason to dissuade stock investors from stocks?
Well, of course, it's on the margin. It may be something, but do remember, stocks have also built in appreciation in them as well as the dividend yield, which the bond does not have.
Fair enough.
The bond is a cash situation, and the stock market can have the appreciation in the stock as well as the dividend yield, which is why I would argue that they are not really in full competition right now. You'd have to have a lot higher bond yields to put them in full competition with dividend yielding stocks. But that's where it is, and that's what the Fed has held down. And the reason they've done that, and the way they've done that, is by expanding their balance sheet. Now, they've expanded their balance sheet hugely to a little less than $9 trillion, which means that they have provided enough liquidity, enough money, enough monetary base, if you will, to provide for inflation continuing without abatement for a long, long time. In other words, it's really hard for them to tighten the money market when they've got the monetary base at $9 trillion, or the balance sheet of the Fed at $9 trillion. It takes a long time to tighten that one up, and I don't expect them to do that anytime soon.
All right, Art, great catching up with you, my friend. Art Laffer.